And there was Guy Johnson there on the ground. For more on this story, we're joined now by Tim Harris, Senior Portfolio Manager at JP Morgan Asset Management, and joining us as well, Derek Kowalczyk, Chief Investment Strategist at CFC Seymour with us in Hong Kong. Derek, let me first start with you first. From where you sit, when you see Northern Rock getting nationalized, does it somehow dent investor confidence in Britain?
To some degree, maybe yes, because clearly the interests of the existing shareholders were probably not being served very well. And the key question is, can we trust a Labour government to make a rational decision, or are they going to make a political decision, fearing the potential gains that could be made by the private bidders? And I'm afraid that this was a major factor which puts existing shareholders at a disadvantage and therefore casts some shadow on the UK capital markets.
Is that fair, Tim? Do you think it will divert some money away from the British economy or British financial markets?
I'm going to tread very carefully here, Ross, because JP Morgan is restricted on Northern Rock explicitly. But what we have here is a FTSE 100 constituent, no longer, a company which got itself into trading difficulties. There was some political expediency to resolve the issue, not so much from a shareholder point of view maybe, but from a customer point of view. The business model is being supported going ahead with the solution the government has now provided. Whatever the micro issues are there, the macro point is that it's business as usual. Companies have gone bust before, companies have gone into administration before, companies have been bailed out before. Okay, we haven't seen a nationalisation, however temporary, for a considerable period of time. I think Rolls-Royce was the one that, when I was in short trousers, I can just about remember. Does that dent investor confidence? No, this is capital markets at work. You have a rather unusual outcome here. I would be surprised if this is to become the trend. Clearly there are political issues going to be made of this, and we'll hear an awful lot about that out of Westminster this afternoon and later on in the week. But it's business as usual. Capital markets move on. Northern Rock, in the normal course of events, would not be a FTSE 100 company this morning. In fact, it is no longer. It wouldn't really be on the radar screen. I don't think this affects Britain's ability to attract capital flows in the normal course of business.
Derek, also on the radar for us here in Asia is PPI in China spiking to 6.1% in January. We're also getting consumer prices coming out tomorrow from China, expected to be at 11-year high. Do you think inflation is getting out of control in China?
I wouldn't say it's getting out of control, but clearly the economic disruptions related to the weather in January have put additional upward pressure on prices. And we saw it today with PPI. CPI tomorrow is also likely to rise quite substantially. The response of the government will probably be made very difficult by the fact that on one hand they would like to stop the inflation and increase interest rates, but on the other hand, if they do hike borrowing costs, it will also hit the consumers and the businesses that suffered during the weather disruptions. So I think we will get a delayed response from policymakers maybe in the second quarter with some additional interest rate increases.
How much of that inflation is due to spike in energy prices, and could it be more practical for China to allow its yuan, its currency, to appreciate faster to handle this inflation pressure?
I think it's most due to the prices of food rather than energy, although obviously the import bill for energy-related products is also quite substantial and rising. The government has to weigh the positives of increasing the value of the renminbi and therefore reducing inflationary impact of higher oil prices, with the negatives related to the hit that some low-profit exporters would suffer if the renminbi did gain in value. I think it's better for China not to allow the renminbi to appreciate too fast because of the negative impact on GDP growth if exports growth does slow.
Yeah, Terence, pick up on some of those points. I mean, there are those who say, look, Chinese inflation is not good for anybody because they start exporting it, and then we've got PPI prices strong anywhere in the UK and Eurozone and elsewhere. How much of a hindrance potentially is that inflation story, or is there an opportunity there for investors?
There's always opportunities, Ross. The most significant axis that my colleagues and I are following this year is that of food price inflation. You can see in the metals field the fact we're talking about Vale and others negotiating iron ore prices at the top end of expectation. We can see coal prices, steel prices reflecting that. So there's some feed through there. In food prices, you can see wheat trading 90% higher. $19 a bushel coming through with shortages, inventory shortages in the US. Now, bear in mind, in wheat, corn, soya, there are multitude of new uses above and beyond food, feedstock, energy, bioenergy coming through. You look at China with this significant balance of payments deficit in food. So there's an axis there. So that's the opportunity. From the macro point of view, is that inflationary globally? Yes, and I think the point which is made there about the yuan being, or the renminbi being allowed to reflate through the course of the year is well made, and that's one which we would have as a central expectation. A reflation of the yuan through the year, that is a very benign influence if you're long Asian free-floating currencies, long assets in Asia, which will trade off that. In my view, I think Chinese equity assets are now deflating after the magnificent bull run they've had over the last 3-4 years. That will bottom out sometime around about mid-year, we think.
Well, I was going to pick up on that because there are those who say, look, we've got earnings and prices in China and other markets like India that are purely unsustainable, and therefore they've gone further and said, we actually think we've got a bubble here that is going to burst and we're going to have a crash. Do you see that potentially, and if so, what would the ramifications be?
Thus far, it's been very interesting. We're all waiting for EME to come down. Now, one part of EME is extremely well supported, which is by natural resource prices. So the Latin American axis, for example, is very well supported. If you look at Asia, which has a shortage, is a net importer in both feed, food, and in metals, precious and otherwise, you may see a different axis there. But we haven't seen that deflation coming through. A shares, by any respect, look expensive, and you would expect to draw down there, but there's a massive liquidity boom going on in China. H shares are not so expensive. If you look at how that translates into Hong Kong, where half the market of Hong Kong reflects Chinese stocks, the other half is basically a reflation trade. You look at real estate, you look at the banking sector in Hong Kong, looking pretty good. Real estate is running with massive liquidity and negative real interest rates. So there are a lot of different stories, a lot of different flows and eddies working through in Asia. I think the Chinese onshore story will deflate further, but I think yuan appreciation, reflation around the region where we have negative real interest rates, a number of monetary regimes are determined by what happens out of the Fed as much as what happens to domestic policy. And some parts of Asia, we think, Singapore, Malaysia, with natural resource plays, parts of Hong Kong, real estate in particular, look very interesting.
All right. Tim, we'll have to leave there. Thank you very much for being with us. Tim Harris, Senior Portfolio Manager at JP Morgan Asset Management. Also Derek Kowalczyk, Chief Investment Strategist at CFC Seymour, talking to us live from Hong Kong. Right.